This is Gamma Explained, what it is and how to trade it.
Hey everyone, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to talk about Gamma. Now, if you're new to this show, this is a show where we construct concepts visually for you. So last week we got into the Greeks. So what the Greeks are, you'll see them on all the platforms, Thinkorswim, Doe. They're basically variables that you can use to get a better sense of different things about your portfolio. So last week we got into delta, which is the rate of change of an options price. And we basically learned how we can use that to hedge our positions, see what our potential probability of being in the money is.
So let's talk about delta real quick, right quick. Let's go to AMD. I always like to pick on AMD. So we're going to go to the October 17th expiration. We're just going to pick a couple strikes at random. So we'll pick the 155 and the 145 and the 175. So we're picking those strikes at random. The 27 delta, the 64 delta, and the 80 delta. What that means is that by October 17th, what I talked about earlier, which is really handy, is what is the price difference for every $1 change in underlying stock. So here, the 145 strike would go up 80 cents for every $1 that AMD goes up. All right. The 155 strike would go up 64 cents for every $1 move that AMD goes up. The 175 would go up 27 cents for every $1 move that AMD goes up. Okay, we've established that. Now, it also is a great measure for the probability of being in the money at expiration. So this option down here at 27 delta means that 27% possibility that it will be in the money expiration. A 64 delta means a 64% probability of being in the money at expiration. And an 80 delta, an 80% probability of being in the money expiration. Okay, we want to start on the right foot. So rather than hoping and praying and saying the rosary and all of your prayers that this will go in the money and gain all this intrinsic value, why not just start in the money? Right? Start in the money and start with a higher delta. And yes, it does cost more out of pocket, $3.15 versus $18, so 6 times more. However, let's look at the actual value, right? The actual value. Well, if it were to expire today, this one has no extrinsic value, so it's worthless. Okay, but the $3.10, which is the mid price between these two, is 100%. 100% of the extrinsic value is the price of the option. And that will decay over time. So 100% over 23 days is 100 divided by 23, 4.37% per day it will decay on average. Okay. Now, if we go deep in the money where Chris would trade, it's 2.42. So we're already paying less in extrinsic value that will decay over time. But what is 2.42 divided by 1840? Okay, let's see what that is. 2.42 divided by 18.4 means 13% of this option will decay. 100% of this option will decay. 13% of this option will decay. So 13 divided by 23 days means this will decay by 56 basis points. 0.56% will decay each day versus 4.34% will decay each day. That is how an in-the-money option is significantly less expensive than an out-of-the-money option,
etc. So today we're going to look at gamma. And the reason I talk about delta before gamma is because gamma is essentially a derivative of delta. So if delta is the rate of change of an options price, that's a derivative of the options price. We've got delta, and gamma is a derivative of delta. So basically what gamma is the rate of change of delta.
Okay, I'm going to do a couple examples. So if we look over here, we can see that as each strike changes, we go from the 60, where it's a 54 delta, up to the 57.5, which is a 59 delta. So that's a change of 5 deltas. Okay, that's your gamma. Your gamma is 5, the difference between 59 and 54. And then we go from the 57.5 to the 55, and this changes by around 5. And then we go up again, this changes by around 5. And we go up again, this changes by around 4. We go up again, this changes by around 1. We go up again, this changes by around 3, around 1, around 2, by around 6, by around 3. Now, of course, it's after hours, so the delta is going to change just a little bit. But the point is that the deeper in the money you get, you approach what's called an asymptotic curve. Hang on, an asymptotic curve. What does an asymptotic curve look like? So if, I have to draw in a blank space, if over time the, what is it called? Gamma starts super high, right? Let's say that it starts at 5. As you get closer to 100, right? Let's say this is the 54 delta. So the x-axis is deltas and the y-axis is gammas. Okay, so let's do delta and this is gamma. And over time, as you approach closer to 100 deltas, it will get smaller and smaller and smaller. It can never cross 0, of course, but it's going to get smaller and smaller and smaller. That is what's called an asymptotic curve. And it goes from 5 down to basically 0.000000005. That makes sense? Everybody following along? If you're following along, let me know in the chat. It is with the number 1 in the chat, if you don't mind. It is the rate of change between each one of these. But as you get closer to 100, it must, of course, get smaller and smaller and smaller. And that's why it looks like this. Now, I like to use it as an example of driving down the road, right? Let's say both of these cars, the Jurassic Park Jeep, right? And then the Tesla Model Y Performance, both of these cars are traveling 80 miles an hour, okay? One of them is pushing on the gas, and so its delta is rising. Its delta is rising, but it's not pushing all that hard, okay? And then this one, the Model Y Performance, and as you know, that's a blazing fast car, brutally fast. In fact, you put it in sport mode, just hang on to your britches. It's going crazy. This one starts at 80 miles an hour and then slams the not gas pedal, slams the electricity pedal, swoosh, right? This has a higher gamma than this does. They're both increasing, but the gamma is going up harder and faster in the Model Y Performance, okay? So that's what we're measuring here, is what is the rate of change, going from 80 miles an hour to 90 miles an hour. How fast is that happening? But there's a key, and I'm sure he'll talk about this in a minute, so I don't want to steal his thunder here. But there's a key point about gamma, which is called gamma risk. As you get closer to expiration, gamma risk starts to explode. So I'm going to tease that out, a little YouTube strategy there, tease that out to see if he talks about it. If not, trust me, I'll talk about it.
So it's great to know and learn all these different Greeks because once you learn them and understand how they work.
Perfect, David. Perfect. Speed versus acceleration is delta versus gamma. Nailed it right on the head. Everybody pay respects to David in the chat. Everybody pay respects to David in the chat. Well done, David.
It gives you a better sense of how different market aspects are going to change your option position. So without further ado, let's get into gamma. So again, gamma is the rate of change of delta. So what we're going to do here is take a look at an example of a trade. We've got a 75 stock price that's at the money. So we're going to look at an increase and a decrease and see what happens to the option price, the gamma, and basically the stock price and how all these things kind of coagulate together. So right now we're looking at a 45-day till expiration call. So if I've got a stock price at 75 and the option price is at 290, and I know that the delta is the rate of change of the options price, if we go from 75 to 76, my option price should theoretically increase by 50 cents, which you can see here. So the option price increased from 290 to 340, given a $1 increase in that stock price. So we can see here that the delta has changed from 50 to 55. And that's because we had a gamma of 5 cents. So this is how everything kind of works together. So again, we've got our stock price at 75, we're looking at an at-the-money call. So if I were to purchase that call, for example, and the stock price goes up to 76, if that call was worth 290 and had a 50 delta, which is what you'll see with at-the-money options, they're most likely going to have a 50 delta because you're going to have.
Tell me in the chat why an at-the-money option has a 50 delta. Quiz, audience participation, go. I'll give you just a minute to type it out. Why an at-the-money option has a 50 delta. Now let's discuss at the money is the yellow line. In the money is where it's gaining intrinsic value. That's the difference between the strike price and the option. I'm sorry, the cost of the stock and the strike price. Okay, that's where we're gaining intrinsic value. Out of the money means it has no intrinsic value. The strike price has not gone in the money yet. 50% chance it could go up or down. Boom, nailed it. 50%, 50-50 chance of in the money versus out of the money, because it could go either way. You guys get it. It could go up or down, out of the money or in the money. Very good, very good, very good. Good job, everybody. Really proud of y'all. Look at you learning. Y'all are smart.
Have a 50% chance of being in the money. And as we learned last week, a delta is essentially equivalent to the probability of being in the money. So we've got this rate of change here, which you can clearly see in the option price increase. And now you can see that our delta goes from 50 to 55. And that's because we have a gamma of 0.05. So what does this tell us? So basically what this tells us when we have longer days till expiration trades is that our gamma risk is low. So what you'll hear on the
Ooh, gamma risk. We're teasing the gamma risk, right? This is like when the Hulk walks into a room with a room full of radioactive spiders and the Ghostbusters are in the corner. Their gamma risk goes off the charts in that room.
Doe, if you're looking at the follow page, people might refer to something as having a low or high gamma risk. So what we like to do is avoid gamma risk altogether, because basically what gamma risk is the rate of change of delta. And if that rate of change of delta is very high, it can basically swing my option price down or up. And that's not something I want to do if I'm trying to be mechanical and stay in a high probability environment. Because if my option price is swinging up and down, it's going to have a lot of variance, and I might be a loser 1 second and a winner the next second. So
that right there, he's kind of fumbling over his words. Let's go back. I want you to pick up exactly what he said right here.
Probability environment, because if my option price is swinging up and down, it's going to have a lot of variance, and I might be a loser 1 second and a winner the next second. So that's not something I'm really
loser 1 minute and a winner the next second. Okay, let's talk about why gamma risk is such a big deal. This is the reason right here why Chris will not hold options the week of expiration. The Friday before. So for example, if I were holding an option and October 3rd were the expiration date, by the 26th, I would have rolled out in time or closed the trade completely. I will not hold anything the week of expiration. So let's talk about why. So we go up to this this expiration, which is going to expire in a couple days. Notice how fast delta changes here. At the money is 61. 57.5 is 76. So we just gained 15 deltas right there. Going from 76 to 90, another 14 deltas, and then 90 to 100. So the 152.50 has 100 delta. We go out to 23 days. The 52.50 is at 72 delta. Now, the reason that delta is collapsing in like that is because there's less time, right? There's less uncertainty. Because there's less uncertainty, we don't need to have, $40, $30 in the money to get 100 delta. We've only got a couple days left. So how about $8 in the money is 100 delta? Because the likelihood of that going out of the money in just 2 days is very low. Can it happen? Absolutely. And this is the gamma risk we're talking about. So if I'm holding the 57.50 and it's worth $5.30 to me today, let's say AMD drops from 160 to 155, right? Somebody comes out sitting on his golden toilet, tweets something. Oh, AMD chips, they're the absolute worst. If you only bought the NVIDIA chips, you would be so much smarter. AMD sells chips to China. Not only is China dumb, but everybody who's bought AMD stock, they're dumb too, right? Something like that could happen. Let's be realistic here. This is crazy times. You're holding AMD's calls, the 57.5, and you think you're sitting pretty. All is good. Next thing you know, price has gone down to 155. Your options are worthless. When I say worthless, I mean, I always like to use a prop. This pressed penny that I got here from the Houston Museum of Natural History is worth more than your 57.5 strike options. That's how worthless it is. Okay? That is gamma risk. However, if we go here and the 57.5, or I'm sorry, yeah, you're holding the 57.5, the 157.5s, and price goes down $5. Yes, you're going to lose money, but all of these still have value. All of these still have value. And that's because there is still uncertainty. And there's still uncertainty because there's 23 days versus 2 days. Does everybody understand what gamma risk is measuring? It is a function of how fast a stock can move in relation to how much time is left until expiration. If your option goes out of the money at expiration, it has no value. No value. You can't walk into the True Value hardware store and say, please give me some money. They're going to say, there is no value here. We've got some great tools, but there's no value in your option. That is what we're trying to figure out, okay? That is gamma risk. That is exactly precisely 100% why I will not hold anything the week of expiration, because it can turn around just that fast. So if that makes sense, type a number 1 like Steven and Ozzy, Ian, and Carol have done in the chat, and Plumber Fred. Look at this. We're getting such deep theory over here. I'm so proud of you guys. Yeah, gamma risk is like when Chris does plumbing at his own house. Yeah, exactly. That is a huge gamma risk. Let's keep going.
Really interested in if I'm looking to get high probability trades over longevity rather than direction. So let's see what happens when we go down one strike. So basically, if I buy a call and the stock price goes down and that call option had a 50 delta or a 45 delta, I should say, then my option price should decrease 45 cents, which you see here. And that's because when you're changing from delta, although the gamma is going to change, it's going to increase and decrease with that stock price movement. So you can see that the option price decreased 45 cents because we're looking at the delta here of 45 cents. So again, the real takeaway here is that when we're looking at 45-day till expiration trades or trades that are not in expiration.
Granted, they sell options. This channel is all about selling options. I lost over $200,000 selling options. I will be the biggest advocate you will ever meet in your entire life to say, do not under any circumstance sell options, because it breaks the golden rule of leverage. Selling options puts you in a situation where you can lose more than you can make, and you cannot break this rule. Now, everything he says about selling options, take with a grain of salt, let it go in one ear and out the other. Okay? It is the fastest way to lose your ass. Trust me, I know.
Expiration week. So expiration week is known to have high gamma risk. You can see that regardless of whether the stock price moves up or down, the option price doesn't sway too drastically. So now we're going to compare this to a much closer to expiration trade, and we're going to look at a 2-day till expiration call spread. So if we look at the next slide here, we can see that we've got the same information. So we're going to just keep it consistent. We've got the 75 stock price. We're going to look up and down one strike, and we're going to see how our option prices are affected now, given an increase in gamma. Because again, the closer you get to expiration, the higher gamma is going to be. And that's where that gamma risk comes into play.
I just find this super interesting. They recorded this on September 15th, 2015. It is 10 years and 9 days since this was recorded. I just find that super interesting.
So we've got a...
By the way, 10 years ago, I was listening to this and selling options. A lot has changed in 10 years, and my trading plan is certainly a lot more zeros in my account because of that as well. I'm just putting that out there.
75 stock price, and now we're looking at an option price of 65 cents. So the option price is worth a lot less because we only have 2 days till expiration. So regardless of where I am, except for in the money options, it's going to be a lot less because there's a lot less extrinsic value, which we learned about in a previous whiteboard. So,
by the way, taking 2 seconds here to recognize Guillermo. He's in his first live stream after joining OVTLYR. So Guillermo, I am so stoked to be here. Guillermo, I would love to get everybody to say, way to go. Glad you're here, Guillermo. G-U, and let's all spell it together. G-U-I-L-L-E-R-M-O. So congratulations, Guillermo, for picking up OVTLYR. Congratulations for being here on your first live stream. I hope that would make you feel at home, my friend.
Extrinsic value is made up of time and volatility, and they kind of combine together. So the less time that there is for a stock to be volatile, the less value there's going to be in that extrinsic value. So now we're looking at a gamma of 0.25. So now we've got the option price at 65 cents. We still have the same delta of 50. So you can see that if the stock price goes up $1, now my option price almost doubles. So we've got this big swing going up one point here in the stock price.
One strike, right? So this is what we're talking about right here. And we can see this in real life, right? It's not just theory, but we can see it in real life happening here on this AMD strike, going from what, 55 to, oh, hang on. I was going to say that didn't look right. Going from 67 to 87 to 100, just that fast, kind of like he's showing here, how the delta is moving just that fast. And the gamma has grown significantly, exactly what we talked about.
Price, and now you see that the gamma is much higher, so it's 5 times the value of our previous example. So now my delta changes from 50 to 75 as opposed to 50 to 55. So this is just going to go higher and higher. So if I was looking at an option price now of 115 and now I've got a delta of 0.75, now if there's another increase, it's going to increase another 75 cents, which is almost 100% of that value. So that's where the gamma risk comes into play. So a 2-point move can drastically change this option price. So you would see if this was...
This is exactly why you don't want to be holding options the last week of expiration, because as you just said, a $2 move can drastically change, humongously change, really, really tremendously change your option price.
75 cents and $1.15, so now it'd be $1.90. So this option price has now pretty much tripled with a 2-point move in the stock price. So if I sold this call here instead of buying it, then I might be at a loser already with just a 2-point move. And that can happen at any time because you know stocks go up and down. There's a lot of random variance in that intraday movement. So that's why we like to avoid this gamma risk here. So let's look at what happens when we go down. So if we're going from 75 to 74, if I bought this call at 75 and it was worth 65 cents, if I have a delta of 50.
Boom. Exactly, Daddy-O. Well said. If you need to email me for any reason, the easiest way, the best way is support@outlier.com. April watches that email box and will send that over to me. And where was that? Yeah, Daddy-O. Now I see why I see why 1 DTE options are a lotto ticket. They are exactly a lotto ticket. We don't want lotto tickets around here. We do leveraged investments.
And we're going down to 25 cents. Now this is going to decrease 25 cents here. So basically I've lost 50% of my value in just one stock point move. So again, you can see that gamma being high is not really good if I want to hold that delta or hold that option price, because when we're looking at a high gamma, we're looking at a high rate of change of delta, which means that when you're looking at a bell curve, so we're going to look at this on the next slide here. So if we want to
go tease that out, the reason gamma grows as it gets closer to expiration. So if you're talking like a leap option, you know, something 90 days, 180 days, long-term option, gamma's not going to move all that much. If you are talking about, you know, I like to start at 21 days or so, it's not going to move all that much, right? Gamma is there. It is the change between each delta, and you can see it on every options chain. And when it gets closer to expiration, that is when gamma really starts to explode.
Throw this up. This would be...
I know it's 8:30 already. I'm gonna press my luck on this.
A great time to talk about it. So when you're looking at a long...
I can't stop, Manny. I can't stop, won't stop. This is my favorite thing in trading. Options are the best.
Longer term day till expiration bell curve, you're basically going to have a wide range of strikes, and the bell curve of probabilities is going to be pretty wide across those strikes. So as you can see here, we're looking at a 45 day till expiration call delta curve. And if we're looking at the 75 stock price and we're looking at just the call side, so we're looking below the stock price. So what happens when the stock price goes from 75 to 74? You can see that the delta pretty much holds its value. So the delta doesn't change too much. So what you're going to see...
It doesn't change too much at 45 days. Just want to make sure everybody's aware that's what he's saying here. The delta's not going to change all that much when you go, you know...
in relation to that option price is... If you're going from 75 to 74 to 73, since the delta is holding its value, you'll see pretty much a stair-step decrease in the option price. Now, if we compare that to the shorter term days till expiration, so we've got the 2 days till expiration here, you can see that since there's less time for the stock to be volatile, basically our standard deviation...
This is a solid chart. This is actually what I want to get to. I saw it on a little scrub preview down here. That is a solid chart right there. As so the 45, hang on, let's repause it where he's out of the way.
Deviation curve goes from this to something much smaller.
There we go. Okay. Looking at the 45-day, you can see how the delta changes, pretty smoothly. However, at the 2-day, you can see how the delta falls off a cliff. And remember, the delta is the likelihood of it being in the money at expiration. How much you're making for every $1 change. Now let's go look at this in reality here. Let's look at the real numbers, right? 2 days to expiration falls off from 61 to 48 to 34 to 24. Okay, let's take a little screenshot and we'll compare right there. Okay, and then let's go out to 23 days just for funsies. That wasn't the right one here. Now let's compare 2 days to 23 days. All right, look how quickly this falls off. It goes from 48 to 35, from 50 to 45 to 24 to 16 to 10. So this is our 2-day right here. You can see just how elevated that risk is. If it falls at all, your delta values are going to plummet, right? You go one strike out of the money, you've gone from 48 to 35. You go one strike out of the money, you go from 51 to 46. You're only losing 5 deltas here. Here, you're losing 13 deltas. So it's 3 times as impactful. And by the way, I know this is nerdy. It is on purposely Options Deep Dive Wednesday. This is only for the smartest of outliers. So if you're watching this, you are one of the smartest of outliers. And I can't get enough of this. This is my absolute #1 favorite part of options. Let's let them finish up this, and then I really do need to run.
Wrapped around the stock price. So what you see here is the reduction in the price from 75 to 74 basically reduces the delta much more drastically. So you can clearly see that this has a much higher gamma than the blue line above it. So if we're going from 75 to 74 to 73, now instead of a steady stair-step decrease in the option price, we've got kind of a drastic slope down. So regardless of whether I'm buying an option or selling an option, let's say I sell an option at 74 and the stock price goes to 75.
Don't sell options.
75. Now, of course, I sold it here, but now it's worth this much.
Okay, we're going to stop. I don't want him to talk about it. I don't want him to talk about selling options because it is just like, it is the worst. Don't do that. Don't under any circumstance sell options. Don't be lured into the sexiness. I was there. I get it. I understand why it sounds so sexy. Sexy? That's what me and my wife do. No, I'm saying, just joking. I understand why it sounds so sexy because the idea of having 70, 80, 90% win rates sounds sexy as F, right? AF, so sexy. The issue comes, which is exactly what happened to me, is that every time I have a loser, it's 6, 8, 10, 12 times as big as my winner, which means I need 12, 10, 8, 6 perfect trades in a row to make up for the one loser. And that's because it breaks the golden rule of leverage. Under no circumstances, from this moment forward, for the rest of time, are you allowed to sell options. Chris has forbade this. Jason says, Chris, I'm a new member. Oh, way to go, Jason. Glad you're here, my friend. You won me over on your YouTube videos. I'm trying to figure out how to place my stop loss on call option contracts using the 2 ATR. How to apply the ATR to call options. So one thing that I never, ever want you to do, and this is the only question I'll be able to take, and I got to run. One thing I never want you to do is put a market order to close your trade. Under no circumstance, do that. Reason being is that options, and I'm going to show you examples here, the spread can widen and contract many times during the day. If, for example, AMD has a quick move up, the option prices will widen. If AMD has a quick move down, the option prices will widen. It is a function of how options work. You can see right here, this is an 80-cent bid-ask spread. We come down here, it's a 10-cent bid-ask spread, 15-cent bid-ask spread. Because of that, that spread can move all kinds of places. And then you will get stopped out, and it sucks so hard. So I, under no circumstances, put any market orders or sell to close orders or any other kind of orders you want to play with. I only do manual entries and manual exits. I do not do anything else. Now, the question was, well, let's say that I need to get out at 2 ATR. Okay, cool. Check this out. So imagine you bought it right here. right? Let's do opening right there. Your two ATRs, it's super easy to measure. You just add ATR indicator on your chart. It's free on any charting platform you can get. Currently, it's at 475. So you would just do 4.75 times 2, 950. You go to the current price you got in at 663.93 minus 663.93, 654.43 is where you would put your stop. 654.43. I need to adjust my templates on here. 654, 40, 654 43. Boom. There you go. That's your stop. It's a pretty wide stop on purpose. Because of that, you need to be trading smaller. This is the stop out point for plan M. Now, one thing that is new that I want everybody to be aware of is we now have a 3 ATR emergency exit during the day. So 3 ATRs would be 475 times 3, 4.75 times 3 minus 663.93, 649.68. 649.68. Okay, boom. That is, I thought I made it red. That is our emergency stop out point. Meaning if something goes wrong, we're going to get out right then. I'll give you a couple examples of something that went wrong. Like VKTX, which is exactly why you never want to sell options, right? This sucks, okay? However, I was able to roll the trade, and it ended up being a 60% loser instead of a 100% loser. Now, I'm not saying that's the greatest thing ever. No, this is a healthcare stock, and healthcare is off the board forever because of stupid, ugly, nasty moves like this. If I had taken a 3 ATR emergency exit, yes, it blew through that point, but I also would have got out before the end of the day. Let's look at another one. Katos, which don't look at Katos. Katos has run hard since I got stopped out. Okay. But let's say that I got stopped out and I took a 3 ATR emergency exit during the day. Okay. Let's look at another one. I think it was DT. There you go. That's a way better example. Way better example on DT. So rather than waiting till the end of the day, if it goes down 3 ATRs, in fact, let's calculate that real quick. So 3 ATRs at that point was $1.47 times 3 minus 56.71, 52.30. So 52.30. Let's see where that's at. 52.30. Oh, didn't even hit that emergency exit during that same day right there. And that's okay. It would have hit the 2 ATR stop point. So imagine with me for a moment that this is 3 ATRs away and it blows through that point. That is an emergency exit. Got to get out today. And F healthcare. F healthcare. So anyways, I do have to run. Thank you so much for coming to the option deep dive. If you're ready to save time, make money, start winning with less risk, click one of these 2 videos, right? That's the whole point of the videos, is to help you save time, make money, and start winning with less risk. And have a fantastic day.